So I want to ask you, when is the last time you signed a contract, say for a credit card or car loan, and you thought as you signed it, I understand every word of this agreement. I'm sure there aren't any hidden surprises here. Yeah, the laughter says it all. It's almost as if we have changed the basic rule of law in contracts. The new rule seems to be the customer is bound, but the lender can cross its fingers behind its back and say, well, we kind of promised one price, but we don't really mean it. And we'll let you know how much this thing really costs on down the line. Now the agency can issue lots of targeted rules. The companies can work around them, and then the agency can issue more rules, and we can keep that approach going. But it won't make the market work. So what I want to focus on is how we get tough, no-nonsense changes that will last and that will address real underlying issues. And part of the answer for this comes from what I've learned since I've been on the job here. I've been out talking to a lot of people, lots of families, lots of consumer groups, but also lots of CEOs and CEOs of very large financial institutions, along with CEOs of community banks. I heard an interesting story from the CEO of a company that has a credit card that you would recognize. We'll just leave it at that. But the CEO told me a very interesting story about that company's business model. He said, we've built our business model around being a price buster. He said the idea is that we simply were willing to take lower margins. We were willing to price credit more cheaply and get out there and compete in the marketplace and expand our market share, and we thought we could make good money on that. And part of our arrangement was we price upfront. We want to make it clear what the cost of this credit is going to be upfront. That worked back in the 1980s for this company, and it grew substantially. He said, but the problem was we hit the 2000s, and he said, I looked at it as a tremendous business opportunity. We were offering and willing to offer a card that was substantially cheaper than our other large competitors. He said the problem was the way the card price was described. And he said our competitors described it as a very low-cost card, very low interest rate, counting on the fact that they would make their profits from fees and penalties on the back end after the customer had come in the door and used the card. He said we weren't willing to price like that, so on the front end, our card looked more expensive. And he said for nearly a decade, we could not put out a profitable card in this market because we were competing against those who were more expensive, but because of the way they advertised, their price appeared to be cheaper. My view is when competitors can obscure the price of credit, the company that makes a cheaper or better product can't compete. So this agency has a moment right now at the beginning to envision fundamental change. It has a chance to define clear goals for the agency and to set a direction that is good for families, good for those in the industry who want to compete for a customer's business, and good for the economy generally. For all the families who learned about the real risks of a mortgage only after they had been ruined financially, for all the families who've been tipped upside down by tricks in credit cards, overdraft traps, and payday loans that seem so safe on the front end, for all the families who learned the cost of sending money to a foreign country only after the money arrived and all the surprise fees had been deducted, this agency has a real chance to offer something better. Now, some will think this is the same old disclosure regime we tried for decades, the one that failed. You know, I'm old enough to remember when disclosure actually meant making people aware of the product they were buying. Isn't that charming? It's clear that over time, disclosure has become a code word for obfuscation. Credit agreements, even well-intentioned summaries like the Schumer box, have gotten longer, and the wording has gotten more and more complex over time. Today, there is much more disclosure, but much less understanding. So it's this simple. No customer should be asked to take out a loan without knowing the costs and the risks of the deal. And every customer should be able to compare different financial products straight up, apples to apples. Regulation should be about making sure that customers have the information they need to make the decisions that are right for them and have that information in a meaningful way. I believe in what the American people can do. When people can see what they are getting, when price is clear up front and not hidden in the back, when risks are clearly explained, and when it's easy to compare one mortgage with 3 other mortgages, or one credit card with 3 other credit cards, then competition kicks in and the market works. When families aren't choking on fine print and legalese, then they don't have to worry about what surprises are hidden in the deal. Now, there are other reasons to focus on easier to understand consumer products and on enabling customers to evaluate products straight up. Just want you to think about this for a minute. American families have the agency they need, but they may have to fight for its survival. Goliath lost, but unlike in the Bible, this is not a one-round fight. To survive, this agency needs clear goals that make sense to the American people. Take a lesson from the other consumer safety agencies. They organize around core principles. The FDA ensures that drugs are safe and accurately labeled. The National Highway and Traffic Safety Administration oversees crash tests for new automobiles to improve passenger safety. The FAA focuses on how to maintain planes so that they're less likely to crash. The Consumer Product Safety Commission makes sure that baby cribs don't strangle infants and that toasters don't explode. This is the work of agencies that enjoys widespread support because it limits the risks that consumers cannot detect on their own at the time of purchase. Thanks to federal agencies, no one competes in the pharmaceutical industry by substituting cheaper baking soda for aspirin. Thanks to federal agencies, no one competes in the auto industry by leaving out the brakes or making seatbelts out of flimsy fabric. And thanks to federal agencies, no one competes in the appliance industry by leaving safety switches and insulation out of toasters. Those agencies have made the markets they regulate more efficient. Safety rules outlaw deceptive or dangerous innovations, and that makes room for good innovation. It also has generated widespread support for the core missions from the public. When is the last time you heard a friend or a colleague, whether it was a Democrat, a Republican, a libertarian, or a vegetarian, complain that the FAA should do less to prevent plane crashes, or that the Consumer Product Safety Commission should do less to make sure that infants are safe in their cribs? It's important that we build this agency with that thought in mind. If the new consumer agency does its work right, not many Americans will complain that it should do less to rein in fine print or legalese. You know, there's strong public support for making credit agreements clearer and shorter. There's a recent AARP survey. 96% of those surveyed want short, easy to understand credit products, and 91% felt strongly about it. This is not a partisan issue. This is an issue about how Americans want to run their lives. The American Enterprise Institute, a very conservative organization here in Washington, has advanced its own version of a short mortgage disclosure